Whether it's the office tower you work in or the mall you shop at, commercial real estate is all around us. It's this massive engine for the economy, but for a lot of people, how it actually works, well, that's a total mystery.
It's a fair question, right? You see these headlines screaming about record high prices one minute and then a sudden crash the next. It's so easy to just assume the whole thing is completely random and unpredictable. But what if I told you it's not?
The truth is, underneath all that noise, the commercial real estate market actually moves in a surprisingly consistent pattern. It has a rhythm, a cycle, with four very distinct phases. Think of it like the seasons of a year. And once you see it, the market starts to make a whole lot more sense. Okay, so let's take a journey through this cycle. We're going to start at the very bottom, right after things have gone south, and follow it all the way around. So our first season is recovery. This is that quiet period right after the storm has passed. The market's hit rock bottom, the panic is starting to fade, and you're just beginning to see the first little green shoots of a new cycle. So what does recovery actually look like? Well, occupancy rates have finally stopped plummeting, they're stabilizing, rents are pretty much flat, and you won't see many construction cranes because, frankly, lenders are still spooked. Now, here's the key thing. Who's buying? It's the smart money. The really opportunistic investors who are quietly snagging great deals on distressed assets, while everybody else is still too scared to get back in the game. All right, so after the quiet of recovery, things start to really pick up. We move into expansion. This is basically springtime for the real estate market. Growth starts to accelerate, and things, well, they get pretty exciting. In the expansion phase, the whole economic engine is just humming along. You've got job growth, which drives demand for space, so occupancy rates start climbing steadily, and as those buildings fill up, landlords get their power back, and rental growth really takes off. Construction cranes start popping up again to meet all this new demand, and all that big institutional money that was sitting on the sidelines, now it comes flooding back in. This is almost always the best time for property performance. After that long, warm summer of expansion, we finally hit the peak of the cycle, hypersupply. This is where confidence can boil over into, well, euphoria, and the market starts to get dangerously overheated. In hypersupply, you look up and the skyline is just littered with cranes. Here's the problem. A lot of these projects were greenlit late in the good times, and now they're all finishing at once. The market gets flooded with new space right as demand is starting to cool off. Occupancy hits its peak and then starts to dip. Rents might still be high, but their growth slows to a crawl. And this is when investors often make their biggest mistakes, paying top dollar for buildings based on predictions that are just way too optimistic. And what always follows an overheated peak? You guessed it, a correction. The final phase, or winter, is recession. This is where the market contracts and basically cleans up the mess from the hypersupply party. During a recession, things go south, and they go south fast. Businesses start cutting jobs, so demand for space just evaporates, and occupancy falls off a cliff. Landlords start throwing in major freebies, what we call concessions, just to get tenants in the door. Construction stops dead, money disappears, and property values decline. It's a tough time for sure, but this is the phase that clears the decks and paves the way for a new recovery to begin. And when you just lay it all out like this, the pattern becomes crystal clear. Just look at that wave-like motion across every single metric, from how full the buildings are to how investors are feeling. See, this isn't chaos, it's a predictable rhythm of growth and correction. So we've seen what happens, but what about the why? What are the fundamental forces that are actually pushing the market through these four phases? Let's pop the hood and take a look. At its core, it really comes down to three things. First, you've got the classic engine of supply and demand. Pretty straightforward. Second, you have the capital markets. Think of money from banks and investors as the fuel for the engine. When money is cheap and easy to get, it pours gas on the fire and accelerates the cycle. When it dries up, the whole thing slows down. And third, and this is a big one, employment growth. It's the most direct measure of demand for pretty much every type of commercial space out there. Okay, so if this cycle is so predictable, how can you actually tell where we are right now? Well, you need to know which signals to watch. Think of these as the instruments on your dashboard. First up is something called the natural vacancy rate. The easiest way to think of this is as the market's sweet spot, that healthy, normal level of empty space. When vacancies fall way below this level, it's like a giant green light for developers. They rush to build, and that is exactly what plants the seeds for the next round of oversupply. Next, you've got to keep an eye on cap rates.
Now, this can sound complicated, but all you really need to remember is this. They move in the opposite direction of property values. When investors are feeling good and prices are high, cap rates fall. When fear takes over and prices drop, cap rates rise. They're a fantastic barometer for what investors are thinking.
Now, this next one is a really subtle but absolutely crucial signal: concessions. These are those hidden discounts that landlords offer, like giving away a few months of free rent. You have to pay close attention to these. Landlords will start offering huge concessions to keep their official asking rents high. It's often one of the very first signs that the market is starting to weaken under the surface. And here's a fascinating little tidbit some analysts have noticed. Now, it's not a perfect clock, so don't set your watch by it, but major real estate cycles often seem to follow this rough 18-year pattern from peak to peak. It's not a rigid rule, but it kind of reflects just how long it takes for all that capital and all those construction projects to work their way through the 4 seasons of the cycle.
Look, understanding this cycle is powerful, but that's only half the battle. The real goal is to actually use this knowledge to make better decisions. So how do you play the cycle to your advantage?
The winning strategy is basically to do the opposite of what everyone else is doing. You want to buy assets during the recovery when there's still fear in the market and prices are low. You want to start your development projects during recovery so they're finished and ready to lease up during the strong expansion market. During that expansion, your job is to lock in your tenants with long-term leases at the highest possible rents. And finally, you sell your assets during hypersupply, when prices are at their absolute peak and euphoria is driving everyone else to buy. You know, this really just says it all. You can't stop the cycle. You can't fight the seasons. Success isn't about trying to prevent winter from coming. It's about knowing you're in autumn and acting accordingly. It's about recognizing the phase you're in and making the right moves for that moment in time. So that leaves us with one final big question for you to think about. Look at the signals around you, the headlines, the number of cranes you see, what's happening with rents in your city. Using this 4-phase framework we just talked about, where do you think we are in the cycle right now?